welcome to this month's Market Update. I'm joined today by KC Lowe, a member of Frontier's Capital Markets and Asset Allocation team. Hi KC.
Wayne.
Well, as we start a new financial year, probably a good time to reflect back on the year just completed and what a year it was. So many moving parts, so much happening, an absolutely cracking year for share markets.
Yeah, it's been an astonishing year. If we think back, we had the COVID-19 lockdowns, then you had the vaccine announcements, then you had the US presidential elections, and then finally ended the year with the UK Brexit finally being implemented. So it's been a lot of events and developments, and despite all of that, financial markets has been really strong, as you said. Equity markets broadly across the key regions all delivered more than 20% in return over the financial year, so it's been amazing results there. A lot of it's been driven by sort of the large amount of government policy support, both fiscal and monetary support that's been pumped into the system, but also the positive sentiment from the COVID-19 vaccines being rolled out, plus economies now reopening. But if you look at it at a more granular level, Australian equities hasn't kept up with other regions, despite our better COVID-19 and macroeconomic outcomes here.
Yes.
But then if you look at the developed markets, they've been the best performing region, and a large part of that's been driven by US stock markets, particularly US technology stocks, which have been big winners from the COVID-19 disruptions. And then if we turn to emerging market, the emerging market region, they've also done very well. A large part of that's been driven by East Asian equities, particularly China, South Korea, and Taiwan, and that's because their economies have recovered really strongly and they've managed COVID-19 a lot better than most other countries there.
So always a lot of focus on equity markets, but just talk to us about some of the other elements of financial markets that impact investors' portfolios.
So government bonds is probably another area to focus on. It's provided a lot of protection for portfolios last year when the market fell, but because of the improvement in the economic outlook, we've seen government bond yields increase over the financial year. And that means that government bonds delivered a small negative return over the financial year. And then I guess the other area to look at is the Australian dollar and just foreign currencies in general. So our Australian dollar moved around like most other assets over the financial year, but it has ended up the year higher, and that's largely driven by improvement in risk sentiment, but also because commodity prices have increased materially over the financial year, particularly iron ore price.
Yes.
So iron ore price started at about $100 per ton at the start of the financial year, and at the end of the financial year, it's at $200 a ton. So quite a big shift there. And if you look at the Australian dollar in reaction to that, we started the financial year at 68 cents against the US dollar, and we ended up at around 75 cents.
Yeah. So certainly investors will be very happy with the 12 months that we've just had, but looking ahead, what are some of the things that you're thinking about and maybe where investors might have some caution?
So I think it's about balancing the economic outlook versus the financial market valuation. So on the economic outlook front, it's still quite positive. You have COVID-19 vaccines being rolled out, you have economies coming out of lockdown, there's a lot of policy support still from governments and central banks, and households and businesses, broadly speaking, have built up quite a lot of cash buffer, which they'll be looking to spend and invest over the next little while. So pretty positive, but that's not without risk. So you still have COVID-19 mutant strains that could make vaccines efficacy drop.
Yes.
Or there could be a mistake in how the policies of support is managed going forward as well. But broadly speaking, it's pretty good outlook. But balancing against that is the valuations of financial markets, particularly equity markets. So one of the measures to look at is what we call the cyclically adjusted price earnings ratio, or otherwise known as the Shiller PE. Essentially, this is a measure looking at the price of equity markets in aggregate versus its long-term earnings. And on that measure, equity markets have not been any higher except for the dot-com bubble in the late 90s. So that would give you a lot of caution there. But what the market is saying right now is that these high valuations is supported by very low bond and cash returns right now. So there's a reason for why bond equity valuation should be higher.
Yes. So, as always, plenty to think about. Thanks, KC, for updating us. And thanks for watching this month's Market Update.